Hello guys. I hope you all are doing well. Today's video is going to be about how the commodity market works. So let's get right into the video. How does the commodity market work in India? Understanding how the commodities market works is one of the most interesting things to learn. When discussing the functioning of commodities market, it is necessary to distinguish between the spot market and the derivatives market. The spot market is a market for the immediate delivery of commodities, often within 4 to 5 days. The delivery term for futures markets is often 1 month, 2 months, or 3 months. The futures market is crucial to the functioning of India's commodities markets, but the spot market is also vital. How does the spot and futures market for commodities function? The spot market is governed by individual states and is outside of SEBI's jurisdiction. Only commodity futures and exchange-traded commodity futures fall within SEBI's jurisdiction. There is still robust over-the-counter commodities forward market in which contracts are tailored to the unique needs of individual parties. In summary, there are 3 markets for commodities: the spot market, the forwards market, and the futures market, with SEBI regulating just the futures market. How does the Indian commodity market work? In 2001, commodities were authorized, and in 2002, the MCX and the NCDEX began operations. Nonetheless, only a few commodities saw a dramatic increase in volume. Initially, commodity markets offered solely futures contracts on commodities. As a commodities market, however, commodity futures enabled both speculative and delivery-based trading. This indicates that the exchange has agreements with warehouses to provide the underlying product to the two parties at a fixed price. The risk was borne by the two parties, and the exchange just served as a facilitator. Prior to 2015, commodities markets were governed by the Forward Market Commission or FMC in terms of regulation. The regulation of the commodities futures market was handed to SEBI in its entirety after the National Spot Exchange, NSEL, scandal of 2013. The Securities and Exchange Board of India, SEBI, has regulated the commodities market since 2015. Commodity dealing on these platforms necessitates standard contracts in accordance with the instructions so that deals may be conducted without eye scrutiny. In general, as with any futures market, commodity futures exchanges standardize contracts in terms of quality, lot sizes, delivery dates, expiration, etc., making entrance and exit straightforward. The trading of commodity options was launched in 2017, but it has not yet taken off in a significant manner, despite gaining momentum in a number of commodities. In India, the volumes on options are largely the volumes on options on commodity futures and not on spot commodities. That is the distinction between commodity options trading in India and trading in other countries. In India, several contracts are prohibited, such as the trading of numerous food crops in commodity futures, because of concern that they might lead to unwarranted speculation and price increases. How are commodities futures beneficial? Commenting on price is undoubtedly one benefit of commodity futures, but hedging risk is also a crucial part of commodity futures. A corporation that must purchase copper throughout the year and anticipates a price increase may purchase copper futures to mitigate risk. Copper miners and smelters may also sell copper futures on the commodities market to lock in selling prices. Both parties stand to lose if the price rises in their favor, but commodity futures lock in prices and provide more commercial certainty. This is the primary use for these commodities futures. Investing in commodities through futures contracts, particularly exchange-traded commodity futures, is one of the finest methods. It signifies an agreement to purchase or sell a certain amount of a commodity at a certain price at a future date. These contracts might be for delivery or merely speculative in order to profit from the anticipated price change. Futures are offered for the majority of commodity classes. Traders use these contracts as a hedge against the risks associated with the price volatility of an underlying finished product or raw material. Trading in commodities entails a significant degree of risk for inexperienced investors due to the need of commodity and global trend expertise. Are commodities worth investing in? In the first place, commodities are not investments. They may be seen as either a wager on the future price changes of various commodities or as a hedge. The hedging includes protection against price risk when an underlying risk is present, such as in the case of a warehouser, wholesaler, or producer of any of these commodities. If you like my video, don't forget to subscribe to my channel. We will meet again with another interesting topic. Till then, stay safe, stay happy.